So at the beginning, I will start, as usual, with some biographical details. You may find it a bit too detailed, but that's part of the format. Actually, the part of it is to give time to later. Good morning, good afternoon, good evening, wherever you are watching us. I'm Nicolas Véron for the Peterson Institute for International Economics. It's a pleasure to introduce this new session of the financial statement series, and we will talk about US bank supervision and deposit insurance following the events of last month, and particularly the collapse of Silicon Valley Bank, of Signature Bank, and the initiatives that were taken by the authorities invoking the systemic risk exception to guarantee deposits without limits, and so on and so forth. So this is very timely. There is a Federal Reserve report, which was initially expected for Monday, May 1, but will, I think, in the end be released a bit earlier on Friday. And we couldn't think of a better cast for discussing these events than Tarullo and Sarah Bloom Raskin. Daniel Tarullo, it seems, comes to the series after every episode of Crisis. He was already here in October 2020 to discuss together with John Cunliffe the Dash for Cash, the liquidity episode of March 2020 at the beginning of the COVID crisis. Professor Tarullo studied at Georgetown, at Duke University, at University of Michigan Law School, from which he graduated in 1977. He served in the US government at the US Department of Justice in antitrust, at the Commerce Department, also in the staff of Senator Edward Kennedy, and then in the Clinton White House as Deputy Assistant for the Economic Policy to the President, in the State Department as Assistant Secretary for Economic and Business Affairs, and then again at the White House as Assistant to the President for International Economic Policy. During the Bush administration, Dan Tarullo taught at Harvard Law School, at Princeton, at Georgetown Law School. He was also affiliated with the Council on Foreign Relations, with the Center for American Progress, and last but not least, with the Peterson Institute for International Economics, for which he wrote a reference book on the Basel framework, Banking on Basel, published in 2008, which gave a cautious assessment of the Basel II framework, which turned out very soon to be completely correct. From 2009 to 2017, of course, Dan Tarullo was governor of the Federal Reserve Board and associated with monetary policy, but also oversight of the financial system within the Fed. And he has also since been on the advisory committee of Transparency International. Sarah Bloom Raskin studied at Amherst and at Harvard Law School, where she graduated with a Juris Doctor in 1986. She then went into private legal practice at Arnold and Porter. She was then counsel to the Senate Banking Committee and worked at Promontory Group in advisory. In 2007, she became, and that's very relevant for our topic today, a state-level financial supervisor as Commissioner of Financial Regulation in Maryland. And from there, she joined the Fed as well as governor from 2010 to 2014. And then after that became a Deputy Secretary of the Treasury under the Obama administration, where she served until 2017. She was at the time the highest ranking female official in the Treasury. And now, of course, we have Janet Yellen as Treasury Secretary, but Sarah, you were the one who opened that path. Sarah Bloom Raskin also has been affiliated since that time at the University of Maryland School of Law and at Duke University. And she's also a partner at PIIE Advisory. With that, Dan, over to you.
Thank you, Nicolas. So I've got 10 minutes and 5 points. So I need to average 2 minutes a point. First point on supervision. Of course, we've got, as Nicolas said, we've got the Barr report coming out on Friday. I think I don't know of any FDIC look back on its supervisory problems with signature, although I think that would be useful to hear as well, just because it would give us some basis for comparison as to how the agencies regard the supervisory failures. One thing for certain, whatever else you think about what happened in early March and since, this was a very significant supervisory failure. Even if you think regulation had been inadequate, or if you thought it was adequate, this was big. What would I look for in the Barr report? I think I would look to see the degree to which there is an assessment of a problem with Washington, either because of the light touch supervisory policies of the last 4 or 5 years, or because the LBO portfolio, the large bank organization portfolio, just didn't see the risks that were associated with rising levels of treasuries being held with unrecognized losses. But that, I think, we'll know a lot more on Friday and can begin to digest the kinds of failures that existed there. My second point, there's been a lot of attention, almost an obsession, with trying to see if you can trace back a particular deregulatory action, either in the 2018 legislation or the 2019 Fed reg, to the failure of SVB. I've tried to avoid participating too much in that because I think it kind of misses the point. The 2018 legislation was built on the false premise that banks between 100 and 250 billion could not, as a group, be systemically important. I think that false premise has been rather substantially exposed. And so it would be, in my judgment, a good idea whether or not we can trace a specific change to the SVB failure to roll back a good bit of the 2019 Fed regulation. The 2018 legislation, if possible, I would like to modify it. That's very unlikely to happen. But the Fed does have authority, even in the 2018 legislation, to do some what I would call sub-tailoring of applying some of its stricter regulations to banks between 100 and 250 billion dollars of assets if they have certain risk profiles. Third point, and this is really a question, and I think this gets into the more interesting set of issues we're all going to be talking about going forward. To what extent did the failures of SVB and Signature and the problems which First Republic is very publicly confronting right now reflect the confluence of a set of conditions that are likely to be non-persistent? And if that's the case, the implication would be that maybe we don't need major regulatory changes. If, on the other hand, these are seen to be less idiosyncratic and more canary in the coal mine kind of situation, then of course would need to be thinking about major regulatory changes. The case for this being somewhat unusual confluence of circumstances, I think, rests on the profiles of the banks in question and external circumstances. So the profiles of the banks in question, uninsured, very high proportion of uninsured deposits. Signature, SVB and Signature were basically, except for the custody banks, had the highest percentage of uninsured deposits of any large banks in the country, 93% and 88% respectively. They also both, along with, frankly, quite a few other banks, had large portfolios of treasuries that were available for sale, whose value had obviously declined with rising rates, but had not been marked to market, and thus they took advantage of the AOCI opt-out, as a result of which their stated capital position significantly understated their real resiliency. And third,
Dan, sorry for interrupting you, but I'm not sure everybody here is familiar with AOCI.
I see. So for smaller but not small banks, they have been permitted to opt out of the normal accounting requirement that would have them pass through any unrecognized gains and losses in their securities portfolios into their capital position. Now, there was a long period of time where that would have increased your capital because securities were increasing in value as rates stayed low. In the last year and a half, there's been a dramatic decrease, obviously, in any long duration security that you bought two or more years ago. And that's where all those losses that Marty Gruenberg talked about in his testimony came from. So those are the internal conditions that suggest maybe these banks were closer to being outliers than representative. The external conditions, well, really, I've already mentioned one of them, which is interest rates. It had been since Paul Volcker that rates had risen as quickly as they did last year, after the Fed misread the economic situation and inflation and sort of persisted in its view that inflation would be transitory. They did a lot of catch up, and they had to do it more quickly than would have been the case had, in the fall of 2021, they begun to see what a lot of people had seen. So if you think, how often are we going to have interest rates going up 400 or more basis points in less than a year? You might think that the big decline in the portfolios of the fixed income securities held by these banks is not something likely to be replicated with any frequency. And then the other unusual circumstance were deposits. I mean, we're all focused on the outflows of deposits from the mid-sized banks in particular, and of course they have been significant. First Republic sort of startlingly so. But if you look at U.S. banks as a whole, deposits are still 25% higher than they were on March 11th, 2000. The combination of fiscal stimulus, the very increased savings rate when people were stuck at home, resulted in a huge increase in deposits in banks that peaked over $18 trillion in mid-2022, came down in the intervening period about $500 billion, and then about $500 billion more. But we're still 25% above where they were in March of 2020. And so one might again think this kind of extraordinary growth in deposits is unlikely, again, to be replicated with any frequency. And so just as they came in, one expects them to go out. One didn't expect them to go out with this rapidity, which really gets to the core of the problem. Was this something that is probably limited to a discrete set of banks, or does it reflect a fundamental change in the behavior of depositors, the nature of deposit funding, and the like? And if so, what kind of changes does that counsel and regulation? So fourth point, to the extent that this is regarded as either idiosyncratic or more than idiosyncratic, but less than a structural change. One might have said supervision is the answer. That's why we have supervision. So we don't have to have regulations that prepare for the worst case for all banks, which would, of course, restrict intermediation and maturity transformation substantially. But instead, we set the regulations at a somewhat lower level and then rely on supervision to identify outliers. If it turns out that we can't rely on supervision, then we do have to think about tighter regulation and what the tighter regulations would mean for the viability of the medium-sized regional bank model, which I think is already under some strains because of the growing importance of economies of scale. If we had more confidence that we could rely on supervision, then perhaps we'd be doing some tweaking, things like changing that AOCI opt-out to make sure that unrecognized losses are reflected in capital positions. But if we don't think we can trust supervision, or if we think that there have been real structural changes in the behavior of depositors, the frequency with which they can flee and the like, then we have to think about more fundamental changes. And as I said, whether those changes are going to be ex-ante type regulatory measures, tighter liquidity regulation, tighter capital regulation, whether it's going to be more deposit insurance with presumably higher premia, perhaps substantially higher premia, whether it's going to include an element of a permanent enhanced lender of last resort role by the Fed, whatever that set of issues, whatever that set of responses, they would effect a major change in how we approach the regulation of commercial banks and not just large commercial banks. And I don't think I don't feel I have enough information to make that judgment right now. We still know very little on a granular level about the deposit profiles of most large banks in the United States. I hope the Fed, after it gets done with the Barr report, will at least in some sort of sanitized or aggregated way put out more information about the profiles of deposits at large banks so that outsiders can make their own judgments as to whether this fundamental change is needed. But I don't want to understate how much would have to rethink bank regulation, and that it's not, just saying, well, we should insure everything, doesn't strike me as a step that should be taken lightly at all. And I would just add, raising the insurance rate to $1 million, that doesn't do anything for runs. You may have social reasons you want to do it, but it won't do anything for runs. Fifth and last point, and this gets to the viability of the bank franchise and bank intermediation generally. Shadow banking, people haven't talked very much about it, but every time we tighten regulation for very good reasons, whether for large banks, medium-sized banks, or small banks, there's some bleeding out of the regulated system into the shadow banking system. And shadow banking has not been addressed except in some of the things that were most associated with the global financial crisis. And if we're going to proceed down a path of tighter regulation for the banks, particularly the medium-sized banks, we need to be aware of both the risks from shadow banking, but also the competition being provided. And I'll just close by saying, in that respect, I was very pleased to see the Financial Stability Oversight Council reviving the prospect of assessing large non-bank institutions to see if they're systemically important. I'll stop there.
Wow, you covered a huge amount of ground. Thank you so much. And I cannot resist clarifying that AOCI stands for Accumulated Over Other Comprehensive Income for the accounting nerds. Sarah.
Okay, well, thank you, Nicolas, and thank you, Dan. I always followed Dan in the speaking order at the Fed. So I'm following him yet again, and now I have to do it even quicker because he did 5 points in 10 minutes. I'm going to take his points, his framework, and see what I can add to them, but of course in only 5 minutes. So here we go. 5 points in 5 minutes, taking them in Dan's order. So first of all, on the supervisory failure point, I couldn't agree more. This is, the biggest bank run in history. I think it was neither a freak occurrence, nor was it particularly unforeseeable. If you look at the way in which this was a supervisory failure, it appears as if there was really a lack of urgency in escalating this through the supervisory channels. So for people who are embedded kind of in how supervision works, it typically starts with an exam report. The exam report will note matters requiring attention. If those matters aren't addressed sufficiently, you bring it to the attention of the board of the bank. The board of the bank will presumably put more pressure on the bank to have the issues addressed. If the issues still are not addressed, typically the supervisors will raise the issue into something that could be an MOU with particular actions that the bank has to take. And still, if the bank doesn't take those actions, what results is it could be a cease and desist, could be the need to raise more capital. But essentially, there is a sequencing of enforcement. And that sequencing appears to have been missing in this case. And I think we've heard some anecdotes that there was a matter requiring attention having to do with the bank's interest rate risk management processes, but we have no indication that was escalated in any kind of urgent way. So on the supervisory point, that lack of urgency, that lack of follow through, I think will need to get examined, but certainly appears to be a feature of the SVB failure. Now, Dan's second point regarding tracing this to a regulatory failure and that potentially being a false premise, I have to agree with that. I would only add kind of one little piece which has to do with the CCARs. So these are the stress tests that were put in place in 2022. The particular ones I want to focus on were the 2022 CCAR and the 2023 CCAR, which unusually didn't include a test of interest rate liftoff. Okay, so there was a recessionary test, right? The high unemployment immediately leading to a flattening of interest rates. But how the CCAR in these years could not have reflected a scenario where you actually are increasing the Fed funds rate at a pretty rapid pace seems to be a blind spot. Now, that again is the importance of kind of meshing what is happening in real time in monetary policy with the experience that the banks would be having, and particularly how the banks are managing their interest rate risk exposures during a period of rapid increases in the Fed funds rate. So I would only add that to the side of the regulatory failure. Now, Dan's third point, is this a canary in the coal mine or something more unusual? It's that, that is, I don't think I can hit that one in one minute, but I can certainly say that we are seeing and starting to see regional bank effects, right, that are affecting regional banks that may not have idiosyncratic or particular business model features to them. I mean, First Republic has announced, for example, significant deposit outflows in the first quarter. We see other mid-sized banks really forced to increase the rates that they are paying their savers, which are going to sort of crimp their expected earnings. We saw statements coming out of Citizens Financial, which is the 15th or so largest bank by asset size in the U.S. We see them telling us that income from lending is going to be down by half. That's their projection. Truist has also indicated, that given higher deposit and funding costs, that the income they earn from lending will also be down. So we have seen significant outflows actually in the first quarter of deposits, maybe more than 90% of those outflows coming from banks that are not the largest four. So bank outflows have been significant from the regional bank and community bank sector. Which, again, doesn't definitively say whether this is, canary in coal mine or something more idiosyncratic. I think that there is definitely things to be watching and keeping our eyes on, but I think that there's more to come. Let's see, and of course, I think Dan's point is very well taken on this idea of the rapidity. I mean, this was one of the features, I think, of this this set of runs had to do with the quickness, the fact that these outflows occurred in internet speed, nanoseconds, which actually did put the FDIC on their back foot in terms of being able to respond, in a way that they might have wanted to had the pace been more gradual. And I think that pace, that rapidity is going to be with us now for probably forever. I don't know whether we're going to go back to a kind of, day by day erosion kind of scenario when we look at deposit outflows. Let's see. I think the point, Dan's fourth point having to do with sort of how do you think about incorporating supervision into your regulatory frameworks, and this idea being that if you've got strong supervision, you can maybe you might not have to do as much on the regulatory side. That's, I think, a very, very interesting and sort of interesting dialectic between the supervision and regulation. I've also been focused on this sort of dialectic, this feedback that can occur between supervision and monetary policy itself. Because of course, if you are, in the FOMC and you're making these decisions on a very, rapid and, fairly predictable pace of interest rate, Fed funds increases, you do want to ask the question, well, by the way, what's going to get broken here? Are the banks, what is the supervisory stance that we are also taking within our same institution that could, in essence, thwart the ability of the FOMC to stay on the path? And we, of course, we saw in the last FOMC decision that the Fed funds increase was not exactly at the basis point increase they wanted because of what had happened on March 11th. So I think there needs to be a feedback actually between supervision and Fed fund rate decisions. Not that I would say that that you have to change the pace of the Fed funds rate, but you have to do a feedback and say, are our banks actually in a position to handle this? Okay, and maybe we have to turn up the supervisory levers. Maybe that was the call for supervision to be acting in a more urgent way.
Right.
And then I think Dan's last point, the sort of the bleeding of shadow, sort of the bleeding into shadow banking. Absolutely, I would, that is something that has to always be considered here. That the more, of course, tightened up that the regulated sector becomes, will create bleeding, will create outflows into money market funds, non-banks, other kinds of entities. And we are seeing that. We are seeing that right now. And this is going to actually tie in, I think, to the discussion regarding deposit insurance, because, of course, a lot of the bleeding that has occurred currently and continues to occur is are these outflows of deposits into money market funds, into places like Apple. You can't call it Apple Bank, but Apple Wallet and Apple Savings, and of course into the large the large banks as well. So so this notion of thinking through kind of implications for the less regulated sector, I think is important as well.
All right. Thanks so much. This was illuminating. In my capacity as a self-appointed acronym police, I cannot help adding that CCAR stands for the Comprehensive Capital Analysis and Review Process. That's a stress testing routine of the Federal Reserve. And on that note, I should mention the blog post by Patrick Honohan at the Peterson Institute, which indeed documented the lack of testing for interest rate rises in those recent rounds. I have tons of questions and the hour will go very fast. So I will ask both of you to make as concise answers as possible so that we can keep covering a lot of ground as we have already done so far. But let me start with the decision that was made to invoke the systemic risk exception on March 12. This decision was very consequential. So I have two questions about it. One, was it the right decision? Was it inevitable? And the second question is, are we already in a regime of permanent and general unlimited deposit insurance because of the anticipation that this decision has generated, or is there a way back? Dan first.
So, we don't have all the facts, but my sense is that the agencies in the Treasury Department probably did the right thing. My observation has been, both living through some of these things in the 90s and then again with the global financial crisis and through history, reading history, that almost any government, no matter what its ideology, when faced with the prospect of a major dysfunction in the financial system, is going to take the steps necessary to stabilize the system. And optimally, you then worry about moral hazard later when you put in place a set of regulatory responses. And, if we think about it, the facts are still unclear, but there's at least one narrative. In the fall of 2008, the Treasury Department thought that moral hazard was a reason not to try to prop up Lehman. And the failure to prop up Lehman set off the most acute phase of the global financial crisis. So there's kind of an object lesson there as well. How you get out of it, that's a more interesting question. So the special Fed facility that is, providing on very favorable terms liquidity to many of these mid-sized banks, that one is time limited by its own terms. And so if the Fed doesn't think it's needed a year from now, they just let it disappear. The special terms for discount window lending with no haircut, that's probably not a hard one to get out of either, because they're the regular discount window decisions that are made. I think the deposit issue is the hard one for two reasons. One, of necessity, the administration and the agencies have been a little bit vague on exactly what the guarantee is, because, of course, they invoked the guarantee that was available to them, the systemic risk exception, which is limited to deposits in failed banks. It requires congressional action to guarantee deposits in open banks. And yet, both Chair Powell and Secretary Yellen implied, in the former case quite strongly, that all deposits were safe. So they're in a bit of a bind right now, in part because they can't be explicit about exactly what their policy is, because if they are, it may be kind of an in-your-face to the Dodd-Frank Act. And I think this one may be a little dicier, and certainly no one's going to be interested with, as Sarah said, with First Republic kind of teetering this way. No one's going to be too interested in saying, well, let's go out with a statement saying, oh, by the way, no uninsured depositors are not protected. So getting out of this may be a good bit harder than getting into it, unless everything settles down and 2 months from now, all is well, and then it'll probably be able to just sort of say off, in some backgrounder, we don't think we need to do this anymore.
But Sarah, let's assume that, things calm down, whether it takes 2 days, 2 weeks, or 2 months, or 2 years. And here we are 3 years from now, and we have a bank of limited size that goes under. Won't it be the case at that time that deposits should be safe because that's what has been proclaimed?
Yeah, I think so. I mean, I think essentially what we've just experienced is, all deposits have really become de facto insured. That is, I think, what the message has been, and I actually am not second guessing the use of the systemic risk exemption given what the conditions were. I am troubled by what led up to the actual failure of supervision in the interest rate risk management category. But I think essentially we have seen really no distinction now between insured deposits and uninsured deposits. That distinction appears at this moment to have collapsed.
Well, then, Nicholas, the issue, though, Nicholas, would be, is there a supervisory and regulatory response in the interim? If nothing is done in the interim and you can let banks get the deposit profiles that SVB got, then absolutely, you're just back in the same position. And so the question is going to be, after the analysis, which I suggested the Fed and the OCC, the FDIC need to be doing on deposit profiles and runnability and the like, what do they do as a response? Do they permit $200 billion banks to have 10 depositors with $1 billion each, for example, with no extra,
So both of you insisted on the supervisory failure. We have several people on the Q&A, including Uday Das, among others, who are trying to give the supervisor a little bit of slack. So they say, what about the managers of those banks, those rating agencies, those investors who didn't see it coming either? Is that an excuse for supervisors to have failed?
No, that's why we have supervisors. If bank executives were perfect, we wouldn't. I mean, if bank executives were omniscient and always looking at safety and soundness rather than quarterly profits, we wouldn't need supervisors. Sarah, I think, put her finger on what I suspect is going to be the issue of problems identified but not followed up on. And that's where that interesting question of why weren't they followed up on? Was it because the supervisors had been told essentially, don't push the banks hard? Or was it because they didn't do it? Look, being a supervisor, I mean, Sarah knows it. She ran a supervisory agency. It's not a lot of fun most of the time. There's a lot of drudgery in the work, and then when you try to do something, the bank gets angry and it gets very fraught. But that's why we have supervision.
Yeah, that's exactly right. I mean, the supervisors tend to be the skunks at the party, right? They're the ones that have to really point out what deficiencies are, and I have great, deep admiration for these people, but you have to be a person who is willing to kind of say it as it is. You have to be forthright. You have to escalate. You need to follow through. It requires a certain character, a certain, really almost a certain kind of courage here to do it well. And I think, to the questioner, I think supervisors, supervisors live in a whole ecosystem in this, of escalation, and we do have to identify exactly, whether and why their calls to improve here were not heeded. So I think that will be important. I should say, by the way, that I think the rating agencies did. They did kind of a halfway job here. They did note in the SVB case that there were potential problems on the interest rate risk side, particularly because of the Treasury valuations. It was interesting. They noted it, but they didn't downgrade. Right. That's actually an improvement over what happened in the financial crisis, where everything came too late. They did note it. And I should also say that there appear to have been some short sellers here who also were focused on sort of unrealized losses where they were sitting in the banking system. So there were a couple of sort of other sort of notes here.
Sarah, you've been a state supervisor. In a way, we've seen 4 supervisors failing here, right? The respective state supervisors of California and New York for Silicon Valley Bank and Signature Bank, and the Fed at Silicon Valley Bank, the FDIC at Signature Bank as principal federal regulator. How do you see that in comparative terms? Is it more shocking to see state supervisory failures, federal supervisory failures? Can you give us a sense of that?
Well, we've seen supervisory failures, in the course of banking history. So this isn't particularly anything new. And, I would be loath to put blame on the states versus on the federal regulators. They work in conjunction. I mean, they work together. They take turns, sometimes regulating, sometimes their teams go in together. You'll have a Fed team, an FDIC team, and, the state of California move in together and kind of coordinate responses. So, I'm not sure it's that worthwhile, a productive an endeavor to kind of, put the blame on, one particular, one particular state or the state system as a whole. I tend to look at this as a collaborative effort because, in fact, it is.
Dan, one question related to that is the organization within the Fed system between regional banks and the board in Washington. You referred to this by mentioning the large bank organization, treatment of things within the Fed system. But can you tell us more? In the case of Signature Bank, what was the division of labor between the San Francisco Fed and the board, and how can we assess that piece of the action?
You mean SVB, Silicon Valley?
SVB, sorry. Yeah.
So first off, just to add to what Sarah said in the same spirit, for supervisors to be effective, their political principles need to have their back. And, no matter how good and insightful a supervisor is, if she feels that she's not going to be backed up by the people in Washington, Albany, Sacramento, she's gonna pull her punches, regardless of what she sees. And I suspect that that's part of what has been going on with banks generally. In terms of thing about Silicon Valley, one of the things about Silicon Valley, it grew so rapidly is that it was almost surely outgrowing, we now know it outgrew its own risk management capabilities, but it probably was outgrowing the level of supervision that it got from the Fed. When it passed over 100 billion and then would be in the large bank organization portfolio at the Fed, there's a different level of scrutiny that applies. But in all honesty, that tends to be phased in. And when you have a rapidly growing institution, it's not like, you're at 93 here, so guys, get ready because in the next year you're going to have they were going like that. They were taking deposits. They bought Boston Private. I mean, they did all these other things. So I suspect that part of what was going on here, and we've got a little bit of indication of that from the Wall Street Journal reporting, part of what was going on was they had a transfer to a different team at the San Francisco Fed. I don't know. I mean, the allocation of response, the smaller the bank, the more discretion the Reserve Bank has. When you get to the GSIBs, to Citi and JP and Goldman, there's a high level of coordination among the relevant reserve banks and the board and the non-supervisory parts of the board at every step of the way. When you're talking about community banks, the level of oversight in Washington is actually quite light. The banks in between, it really kind of depends. It depends usually on whether a bank is thought to be a problem bank or not. There's supposed to be more scrutiny on issues that would be common to those banks, which you would have thought would have included unrecognized losses on large portfolios of treasuries.
So it's not a hard threshold at 100 billion. It's kind of a gradual scale of involvement of the board, or how?
No, when you pass the 100 billion, you get moved into the LBO portfolio. But what I'm saying is the way that when banks are growing gradually, a bank when a bank hits 90 billion, it's been growing organically. The supervisors will say, guys, you're not that far away from moving into a different portfolio. You need to start thinking about risk management, your board risk committee, a different set of expectations around liquidity management, all those sorts of things. And usually the bank is starting to prepare for that. That's often when banks will go out and hire consultants who have worked with the bigger banks and say, how do we prepare for this? When you've got a bank sort of blowing through the levels of different supervisory portfolios very quickly, there's no preparatory time. There's no time to get used to things. The thing is, once you go over 100 billion, for your stress test, you don't get the stress test the first year. You get a dry run or a dress rehearsal stress test. So that too is gradual. Although, as Sarah said, it doesn't matter whether SVB had the stress test, because with no interest rate shock, they weren't going to look like a problem anyway.
I have also a question of international comparison. I mean, many of us tended to look at the Fed and the US supervisory system in general as kind of the reference in international matters. And that was associated with the comparative perceived supervisory effectiveness, especially with comparison with, for example, Japan or European countries, which had blatant supervisory failures in the 90s or in the 2000s, early 2010s, and the US looked good by comparison. Is there an inversion now? I mean, to its credit, the European Central Bank has not been bragging too much in terms of not having an obvious supervisory failure recently. But how do you see this kind of mental map of where supervisory practice looks best? And correlated to that, do you think it will lead the US authorities to look outside of the US for ideas on how to improve, or is that completely a non-starter?
I'll just say, I doubt that the U.S. is going to look outside its borders for sort of models in supervision. I mean, the way the supervisory process of banks really evolved in the U.S. was through our system of federalism. It was really through this idea we have in the U.S. We started with state banks, with very localized banks, and we only gradually moved into sort of this two-tiered structure where you have national banks and state banks. In kind of this balance, sort of equipoised in terms of, who's examining, who's supervising, who's regulating. That is, Dan might know more for sure on this, but I think that's pretty unique to the U.S. In terms of how supervision has historically been done here. I know also that a lot of the kind of supervisory best practices come from understanding how you examine at a local level, kind of what it is to have these small banks, even mid-sized banks, and how they get examined from a very localized perspective, and then melding that perspective into bigger generalizations that can be useful for best supervisory practice writ large. So that I think is a very U.S. specific phenomenon. It's unique to us here.
But wait a minute. I mean, the ECB has been telling us for 2 years that they were very focused on business model risk and interest rate risk. Isn't there something to learn on the face of it?
So I think I would say on that point that I don't know that we need to learn something in terms of techniques from the ECB, from the SSM, or from the EBA or any of the European entities. I think we know what the techniques were, but just to take a contrast, the European stress tests have been better for the last several years than ours have, right? And when we started this, and this is self-serving, but when we started stress testing, I thought ours were a lot better.
And Boris Goldstein at the Peterson Institute agreed with you.
Yeah,
in his book about stress testing.
That's right. That's what Morris. That's right. And he documented. I mean, Morris. He documented extremely thoroughly. But I would say that this gets to supervision. Supervision has been more important in the U.S. for reasons Sarah explained. Supervision goes back, at least to the 1830s at states and at least to the 1860s in the federal government. Supervision meaning a presence in a bank that's something other than just saying you need to follow these rules. I think it's been a big advantage for the U.S. in some cases and can be a big advantage for the U.S. in some cases. But supervision is much more opaque to the public, to legislators, to academics than regulation is. Everybody can look to see what the rules are. But it's very hard to see how tough are the supervisors being? Are they following up on things? Even with respect to the stress test scenarios, you can get some critiques of those, but it's a lot harder to penetrate what's going on there than it is with rules. And so I think what we've seen in the last 5 years is the ability of a set of the heads of the agencies to relax supervision in terms of stress test scenarios, intensity of supervisory oversight and the like, which happens it's sort of a low-level deregulation, low-intensity deregulation. The Europeans, I think, have seen themselves in a bit of a better position, in part, to be honest, because of the ECB's genuine independence. The Fed is independent when it makes monetary policy, but it's much more tied into the government, and the head of supervision is appointed by the president and all that. The ECB, as with monetary policy, has kind of established a bit more independence. They do fight with the member states still. And interesting, Sarah, they now have their own brand of federalism problems, but they're in the last 10 years. But I would say that it's that remove and independence of the ECB, which gives them a bit of a leg up as we go back and forth with policies fluctuating more and more with each administration. And every time the Supreme Court makes another decision, we have more fluctuation between administrations. So, yeah, I kind of think I've always been a fan of the SSM and certainly the people running the SSM. And I think they're really starting to get their sea legs now, to tell you the truth.
Yeah, just to put a fine, I just want to put one fine point on something, So, Dan says, it's hard to actually get supervisory outcomes made public. Not only is it hard, it's actually illegal. Okay, it is embedded in law that exam reports are confidential. This is called confidential supervisory information. And so for the public to be able to see what is, what is going on in terms of what examiners are saying, it has been explicitly made prohibited. That cannot be.
There's a question from Anna Gelperns that dovetails with that. She asks, how do you rebalance the need for confidentiality and accountability in supervision in light of recent events?
I think one thing that, first of all, thank you, Anna, for that question. As the banks actually want a chance to be able to, their argument is give us a chance to work this out. We don't want examiners to be publicizing immediately what they're finding, actually as a check on supervisory power. Give us a moment before making anything public. And so most of the enforcement spectrum that I talked about, that begins with, a matter requiring attention in an exam report and leading all the way up to a cease and desist, most of that is going to be in the realm of being confidential. Only at a certain point will the results be made public. So, and that has been thought about explicitly. in the law. So the question.
So basically, the very notion that Anna refers to of supervisors' accountability is kind of self-defeating, or how should we think about that?
Well, no, I think we, again, it is this kind of balance where, you want to give the bank the chance to fix the issue, right? So you'll give them kind of the cover of secrecy here for a bit of time, but in order for that theory to work, the examiners have to be persistent. I mean, they can't just kind of say, okay, you can, we're giving you unlimited time here to fix the issue. They need to be accountable. Now, one idea I think that is probably worth exploring in all of this is sort of the generalizability of supervision information. So one thing that I think can be done is you can anonymize results by talking about more specific, more generally what is happening without naming banks, and without kind of, sort of permitting a reverse engineering that gets you to know what the banks are. So that, I think, and that, by the way, is a function, the FSOC can be doing that. There are,
right.
The regulators themselves can be doing it.
As a Financial Stability Oversight Council, Julian Jürgenmeier is asking whether supervisory discretion is a problem in itself, as we have observed the examiners not taking the escalatory actions that you referred to. Should the supervisory discretion be constrained as a response?
Well, so, I mean, I haven't said it to this point, but need to say, many of the large banks and people who represent large banks have been waging a campaign against rigorous supervision for some years now. There are congressional hearings in which, again, representatives of very large banks have literally said supervision is nowhere mentioned in Title 12 of the US Code, which is just wrong. It's in there, and it's a function that's in there. So I think, when Sarah rightly refers to lack of follow-up, lack of persistence, one has to ask the question as to why and how supervision remains rigorous, and can it remain rigorous? And that's why I referred to its opacity, that even if you could find out something, it doesn't make headlines. It doesn't make headlines. And what supervisory discretion, if we want to constrain, the banks wanted to constrain supervisory discretion to make sure they couldn't do as much. If we want to confine supervisory discretion to make them do things, it's a lot harder. It's just a lot harder. How do you make guys be more rigorous when you don't have someone standing over them? And I think that's what leads us to the question, will you need to have more regulation or stricter regulation if you don't think you can trust the supervisory process? And so that's when you have to think about, Sarah, when Sarah was talking just a minute ago, I was thinking, this supervisory report that the Fed puts out every 6 months, I don't want to say it's worthless, but it's not worthwhile. It doesn't tell you very much at all because it doesn't do what she said you need to do, which is to have the Fed distill and sanitize the individual banks, but to talk about what's going on in the industry, what the supervisors are actually doing, what their priorities are, what people are saying in those LBO and LISIC meetings. The problem is, Nicolas, even if you say that, who's going to really monitor it? Who's going to follow up on it? And believe me, I have tried to get members of Congress interested in it. The only time you can get interested in it is when a bank fails. Right? You can't get them interested in it and when things are kind of going okay, and I get that.
So we've been talking about supervision, and personally, I would continue for an hour or more, but our hour is coming to a close, and in our title, we also had deposit insurance. So I want to come back to it as a conclusion. Mark Whitehouse and André Lubide are asking about unlimited deposit insurance, but in different ways. Can we come back to that? And especially if it was to become explicit, which I think is the prior in both of their questions, what measures would have to accompany such a shift? Or, as Dan, you suggested, is that a really bad idea that should be resisted? But then coming back to something we already discussed, how to engineer the move back to a credible limited deposit insurance. Maybe Sarah first and then Dan next as conclusion.
Sure. So, I think this is kind of the question of where we're headed. Where are we headed here? I mean, we have, I think, seen some good, to put this in, to not be completely negative, to see kind of the positives that we have drawn from this run. I mean, I think we've seen financial casualties, but they haven't been full-blown. We haven't seen a full-blown collapse. I think that's good. We're seeing a credit squeeze, but we're not seeing a credit crunch yet. I think that's good. Okay. And keep in mind that there were no government equity infusions. Okay. And I think that's kind of worth something. Okay. So I do want to kind of remind people that there was, this wasn't a complete.
It could have been worse.
It could have been worse. Right. Now, that said, where we're headed, I think, is a significant widening of the state's safety net as policymakers feel that they are unable to contain a potential contagion. Okay, so we are seeing, and this isn't just what we saw with SVB and Signature, but it's what we saw in COVID. I mean, we are seeing an expansion, really, of both from a monetary policy side and a fiscal policy side, an expansion of that use of a so-called safety net for the financial sector. And I think that how deposit insurance is going to play in that is something that is going to be one of the next chapters that comes from these discussions.
So here's the kind of law school classroom way of asking the question. Are we, if we were to think about moving to a unlimited or hugely expanded coverage of deposit insurance, what would it take to get the banks and the banking system and financial intermediation to internalize the implicit costs there? I think by any reasonable analysis, it would be a substantial increase in some combination of capital requirements and deposit insurance. I think that as a political matter, it would be very difficult to get the the appropriate level of increase in deposit insurance and capital and/or capital. And that would come at the cost of some significant cost in intermediation. So there may well be a de facto subsidy coming out of this process where you really are subsidizing. And if you're doing that, then you probably need to make some regulatory decisions about where and how you're going to permit deposits. And, I don't think it should escape us that the beneficiaries here were a bunch of very affluent people. The beneficiaries of what happened in March, very affluent people. And so as a distributional matter, this was not great. So if that's the direction in which you're going to go, I think it is going to require that kind of thinking, and at a conceptual level, ex ante. Second thing, and this is just, again, a law school classroom type question, are we basically saying we're giving up entirely on market discipline for any bank that isn't in the repo market, which is to say most banks? We know that banks, the really big banks, the guys in the repo market, the guys with the short-term wholesale funding, which heaven knows is runnable, we know that there's market discipline there. It may not be optimal all the time, it isn't, but there is some market discipline. If we are saying to ourselves, look, this whole notion that people put in $25 million deposits are actually looking at the bank, if we think, no, that's just misguided, and was saying any bank that's smaller than, half a trillion, there is no market discipline except, shareholder equity return market discipline, then that's also a significant change in our model of bank regulation. And that's Nicolas, why I don't foreclose any of these options. Again, I don't think I know enough, and we may have to do something pretty dramatic. But I think it's very important that people not back into it. In 2008, all the things that were failing, there had been a bunch of people already thinking about capital for years. And we had a set of proposals ready to go. I know the administration has scoured the earth for good ideas about how to move forward quickly in responding to these problems. And I don't think anybody has really addressed them. And so that counsels to me taking the time to figure these things out. This may be one good thing about congressional inaction. I don't think we need to worry about Congress moving too soon on anything.
On this note, your point on the very affluent depositors of Silicon Valley Bank, by the way, was made by Ismail Erturk also in the Q&A. We haven't been able to answer all the questions that were asked in the Q&A. That's my fault. I'm to blame for that, but I want to thank our two speakers for extremely thoughtful insights. And also, I should say, for very non-partisan insights. This theme has been taken into its usual Washington partisan football game, but you have escaped that piece of reasoning completely. And I want to commend you for that. Our next session will be on May 10 on Chinese financial intermediaries and why there are so few of them in the private sector, unlike other industries in China. Our first speaker will be Qiao Yide from Shanghai Development Research Foundation. Second speaker, Victor Shi of University of California, San Diego. Again, many, many thanks to Dan Tarullo and Sarah Bloom Raskin. We're ending a little bit after time, but it will well worth it. And have a great rest of your day. Thank you.